Well, are we in a market bubble that is about to burst? Well, we are going to talk about that today. And I'm going to tell you about the time that I met Warren Buffett and how he compared himself to Bill Gates. I think it was kind of surprising to me, but I'm going to go ahead and share that with you. I'm joined by Doug here today. You are watching Filibusted live. Doug, welcome. Are you excited to get started today?
I am so excited. I love this kind of topic. It's super fun.
It is a lot of fun. I think we're going to try and keep it short and sweet today, but it's kind of tough when we get into some of this. So we're going to jump through. I'm going to tell my story here in a little bit about Warren Buffett, but we're going to jump through kind of what's been going on. So, I mean, Jerome Powell, he's the Fed chairman, and he's been teasing out expectations of interest rate decreases, lowering in September. And so, of course, Trump has been pushing him for that for months and months and months and just ranting on him about that. And so we don't know exactly when it's going to happen, but we're kind of thinking around September 16th or 17th. And so it'll be interesting to watch that. So, we do have a few people that are talking about, there's this big thing called the Buffett Indicator. And so this is just this article is talking about the Fed rate from Reuters, but there is an what's that?
Oh, I was just saying, yeah.
Well, okay. So there's, So there's this guy, big financial guy on YouTube, Graham Stephan. And so he has this video here about the Buffett Indicator. And so if you don't know who Warren Buffett is, so Warren Buffett, he's a legendary American investor. He's chairman of Berkshire Hathaway. I don't know what the stock price is today, but it's like $90-some thousand to buy one share. And it's never had a split. So it's just, I don't know, it's very fascinating, but he's widely known for his long-term.
Actually.
Yes, never had a split. And so it's he's known for his Berkshire Hathaway, his company, his investment company. They just buy and hold. They kind of let people operate. And he's known for his value-based investment strategy. So he's never really chased tech because he says he doesn't invest in stuff he doesn't understand. So, I mean, I think he holds is it 5 or 10% of Coca-Cola? Like he buys and he'll buy like a little shop on the corner that he likes because he just likes the shop. So, I mean, it's kind of, he spends his day reading stuff. And I mentioned that I got to meet him back in, I think, 2007. So here's a book I got that he signed. That's just some evidence that I met him. This is about him. He didn't buy this. I don't remember how I even got the book. But I was doing my MBA, and we all got invited to go down to Omaha. And I went to Iowa State University, and so we went down, and it was like a Q&A. And I actually got selected to ask a question. And my question was so profound that I don't even remember what I asked in front of everybody. But I'm sure that it revealed that I was just some punk MBA student that was trying to look like I knew more than I did and showed that, whatever. So anyway, so I asked my question in front of everybody. He gave his answer. I remember it being a very good question, like I said, and a great answer. And so then I sat down. Well, then afterward, we were all kind of down in the lobby and we're all standing around. And he's just standing there talking with everybody. And I don't know, you're just used to seeing this guy on CNBC or whatever real news channel talking about money and all kinds of stuff. And we're sitting there talking, and somebody asked him what his typical day looks like. And so he says, well, I don't like meetings. I spend about 6 hours a day or more just reading reports on different companies that I would invest in. He didn't even have a computer on his desk. He just reads literally printed reports. That's what he says he spends his time doing. But he compared himself to Warren Buffett because he said, I really don't like meetings. He compared himself to Bill Gates. And he said, he likes meetings. He's in meetings all day long. He doesn't have time for anything. But look at he literally pulled up his calendar on his phone and there was like nothing. It was like 3 meetings in a week. Like it was like no meetings. So he's like, we just let our companies run and, we invest in them when they know what they're doing. And so that was my big takeaway is I need to have less meetings, and I also need to have hundreds of billions of dollars in cash to invest. That's my takeaways from meeting Warren Buffett. So
the key to getting rich is being rich. So first,
I'm struggling with the meeting one. So after I get that then I'll go on to the getting billions and ready. So anyway, that story took longer than I thought, but I thought it was interesting. That's
a great story. I love that because it just goes to show that investment is about actually believing in what you're investing in.
Yeah, that's his whole kind of strategy is just you need to believe it's a good thing and invest in it. If you don't understand it, don't guess. Like he doesn't spend his time doing that.
Yeah, and that's the moral of the story there.
Right, there you go. So let's get back into this here. So some of these indicators of a potential bubble coming. So one of these is called the Buffett Indicator. And so it basically right now just says it's strongly overvalued. And so what it does is it takes the total U.S. stock market value and divides it by the GDP, the U.S. gross domestic product. And if basically it says if it's over 200%, then that's a bubble that could potentially burst. And so we're at 217% now based on that calculation. And so this picture here, I don't know if you can see it very well, but what this has is it has the trend line here in the middle, and then it has what's called standard deviations up and down from there. And so you can see we're really outside even the second standard deviation, or right by it now, starting to come back. And so the question is this going to burst or is it going to just be a correction? And so I don't know if you have any thoughts you wanted to share on that chart, but otherwise I'll jump on to our next investor here.
I think it's an interesting chart, but I do have thoughts, but I think they can come later. Let's look at what these guys have to say, because my thoughts more directly relate to what these guys are saying.
Okay, perfect. So let's go on to Jeremy Grantham. I think I'm saying his name right there.
I think so.
I haven't followed this guy much, but he's a British investor and co-founder of GMO. He's famous for accurately predicting major market bubbles and crashes through his data-driven analysis. And so quite an interesting guy. But a few years ago, he warned of a 70% chance of a crash happening, 70% chance. And so I think he altered that down from 85%. And so, but anyway, he points to the bubble and says the reason it hasn't popped yet is because of the emergence of AI, which I don't know if you can unpack that a little bit. I didn't get a chance to dive into that, but I mean, I think we see that maybe that's because you have a lot of stocks coming up that are AI stocks that are pushing even more instead of what would have already popped or deflated a little bit. We're seeing a push because of AI companies.
Yeah, look at NVIDIA and just how successful they've been, and they're the forerunner in AI right now for bigger projects and stuff. And then also, I think in addition to that, the hundreds of millions of dollars that Trump has pulled into the country, like investments into the country that are all predicated on AI programs and infrastructure and stuff like that. And so I think that has pushed the economy forward a little bit, because we've got money coming, and even though it's not like all in yet, it's working its way into the country via these investments from other countries and other companies and stuff like that. So I think that's probably what he's getting at with the AI concept.
Yeah, and I think that it's fascinating too, just thinking about, I don't know, we've talked a little bit about how, I don't know if have we talked on this show about NVIDIA and how Trump, what he said we could sell, what they could sell China as far as chips.
We did a story. Okay. I don't remember. I think Troy did it or Reese did it, but
so
it was on the chips and how China is getting like second-rate chips now because of Trump
because
did.
they Trump says they're not going to get the latest and greatest, and so they're our competitor, and they're stealing a lot of technology anyway. So is it DeepSeek or what's their, I don't know, Deep Blue or whatever. DeepSeek, their big AI thing. Well, it couldn't even run on their own chips. It failed. Right. And so, they can have the second-rate chips. But anyway, I just thought that's a pretty big flex. That's pretty fascinating to see that. Funny. But anyway, let's continue on here. We're going to talk about Dan Penna. And I don't know if you guys haven't seen this guy. This guy is has very colorful language, I'll say. But
warning, content warning.
Content warning. We're not going to watch any of it on this. But the thing is, he's I think the way you put it, Doug, is, he's right. And so that's sort of the summary, is a lot of what the $1 trillion man is what they call him. And so obviously very wealthy, very well off. He's got his own programs, coaching people and all kinds of stuff. But I think he's fascinating to listen to. But, he published a video in April, and he talked about, basically it was a response to the tariffs. And he said he wasn't even watching the political stuff like that. And so he wasn't even really paying attention to it. But he basically claims that we're definitely due for a correction and maybe even into a bear market rather than a bull market, which is what we've seen. But, he made another remark, and he kind of pulled up Warren Buffett quotes, and which, we talked about Warren Buffett, but I was wanting to see if we could show, there's a quote that he pulled up. I'll see if I can pull it through So here's where he says, bad news is an investor's best friend. And so that's what Warren Buffett says. So he's obviously talking about investing when a crash comes or when a correction comes, is a good time to buy. And that's another thing that the first guy said, Graham Stephan, he's that big financial YouTube guy. He said he basically is like, just keep investing as you normally would. Like that's on the way down, on the way up. And he kind of gave some examples of, if there was a correction or a crash, but you had invested money and then did nothing for a certain amount of time, even if you invested at the peak, but you left it in, and it eventually in 10 years, it will come back above where it was. And so I think it's fascinating. And so I think we got some charts we're going to get into a little bit here where there was panics and people sell, and it's kind of wasn't really necessary to do that. But anyway, so this Dan Penna, he goes into another interesting area where he says that the markets always find a way to correct themselves when they're overvalued. And so he said this time it was tariffs. Now I will say that's quite exceptional. Well, we always say it's exceptional, these corrections, but that's really a restructuring of the global trade system. That's really what Trump is doing with tariffs. It's not about let's make a quick buck. Yeah, that's a side benefit, but it's really about having a new global trade system. That's really what and Penna, even Dan Penna even talks about this, where he says, this is about putting countries back in their place that have been taking advantage of America for all these decades and decades. And so he pointed to, in 2008, it was mortgages that led to the correction. And in 2000, it was the Y2K and tech and all that stuff. And so he says, maybe we're coming for a recession, but not a depression. So that's kind of what, that's what he had to say. And so, I don't know, I think it's interesting to see these different takes and just to kind of be aware of this. And obviously we need to be diversified. That's another thing that these guys talk about is, it's good to have cash. You want to have 3 to 6 months of expenditures on hand. That would be ideal, like an emergency fund or a safety fund, whatever you want to call it. But then be diversified so that if one thing's going down, other things are going up. And so these guys talk about their different strategies and that sort of thing. But, okay. Any comments on that? Otherwise, I want to get into this interesting theory that has come out that I'd like for you to share with us, Doug. So any thoughts before we jump into that theory?
Yeah, I just think that I hear like these, I think it's doomsaying really. And so I think that it's important for people to remember, don't panic. It always comes back up. Like historically, you can look at it. I don't understand why people have this thought where the market's crashing and then they pull everything out, and because it comes back. So, but sometimes it takes 10 years, and that's okay, but it still does. Unless you're already invested in really bad investments, then that's a problem from the start. That's a different issue. But I think that to compare what's happening right now to the Great Depression kind of warning signals, I don't think that's really the best comparison, because I know that there are some ways you can do that, but that was a completely different era. You didn't have people at that time frame who had constant connection to the news worldwide and who could literally move money from their pockets to their from bank to bank within the thing that's in their pockets. I'm getting at cell phones. Like you didn't have the kind of people who were invested in the stock market. It was a lot of normal people, and then you had rich people who were manipulating the stock market, and then normal people who just had to deal with it no matter what. Now, I mean, you can download an app and be a part of the stock market and trade the same stocks that the rich people were trading that you could only do if you worked full time as a trader back then. You know what I mean? So you can't compare it across the board. And the way I like to say it is, it's not apples to apples. That doesn't, it's not apples to apples. It's apples to oranges, right? But that doesn't necessarily mean that it can't happen, because fruit still rots all the same. But they're different fruits. So I don't know. I just think it's kind of important to make sure that we understand this is not the same era that the Great Depression was. But I don't know, maybe we do end up in the same boat, but I don't think so, because I'm kind of on Dan Pena's boat with this one. I don't think it's going to be a depression.
Yeah, and I think it's a good analogy of, now since we're talking about boats, like there's a difference between seeing a boat is actually going to sink and getting off of that boat before you get sucked down with the suction of the huge boat going under the water. There's a difference between that and seeing like a hole in the side of the boat and then patching it and then staying on the boat. Like there's a big difference. And so that's kind of the question is, okay, how much water is coming in? Can we get it out and maintain it and keep the boat afloat?
Until we get to shore, or are there too many holes and we can't make this thing go to shore? Yeah. If you're watching, you can see the warning signs. If you're not watching, and the people in the Great Depression were not really watching, the general populace were not watching because they couldn't. They didn't have that. We do. We can all watch.
And there's a difference between sort of all of a sudden paying attention to something and comparing it to the little bit that you've been engaged with versus like watching things for decades or even years and seeing the patterns. And so that's kind of what we're talking about here, is some patterns. And so speaking of patterns, Doug, let's jump into this theory that you shared. I think it's pretty interesting. I'm going to pull it up here.
Yeah, I actually just found this morning, but it coincided with something that I had found a while ago. And I was like, oh, this is really weird. But I do think that everything goes in cycles. Everything is a season. That's just how life is in general. And even the Buffett chart shows that's all seasons. But this is called the Dicial Theory. I'm pretty sure I'm pronouncing that correctly, but I might be wrong. So this theory posits that the market moves in predictable 10-year cycles and even describes what to expect for each year based on the last digit of the year, which sounds kind of voodoo-ish, you know? And I'm like,
That
what?
sounds
Like
weird.
literally the numbers, like this is numerology or something crazy. But
Right.
so, you know, first you're going to be a little bit hesitant because you're like, well, that's odd. But then you look back on the history of it and you're like, but it's accurate. So
A pattern's a pattern.
a
Yeah.
pattern's back.
So what do you do?
Yeah, but here's the way that I look at things like this. This is not magic. This is designed this way. You know what I mean? Like there's a reason why this is happening like this, and people are paying attention to it, and people are the ones who are making things happen in these cycles. It's not voodoo.
Right.
But the
So
example here is for years ending with the number 5, just so everybody knows, which obviously that'd be this year, the market has a tendency to climb and then start leveling out for the next year. In 2026, it kind of just stays pretty generally okay. And this is in degrees too, you know. So it's like the market might be down in this particular section and is doing all of these things, and then we bump up. We're in this bump up stage right now because the market is very highly valued. I don't know if it's overvalued, but it is very highly valued right now. And this just all happens to coincide with this crazy thing that I found this graphic years ago, before AI, by the way, just so
yeah.
everybody knows. And so I had to pull it up. And this actually was written in, what was it, 1875. And it's basically this decennial theory. In essence, it has the same thing. It shows you the little arrows, and if you can literally look, if you guys are interested, you can look up this periods when to make money chart, and it'll come right up on Google, and it shows you how, like, when to expect a peak in the market and when to expect a dip in the market, and it describes the whole thing. So I encourage everybody to go look at it. It's very interesting. Don't make big financial decisions based off of that. And also, by the way, don't make any big financial decisions based off of anything that we're saying right here. None of this is financial advice. We're just speculating. But I just thought it was interesting that this decennial theory kind of ties in with this chart that I saw a while ago. And I don't know, it's interesting for sure. But so the 2027 year, and years ending in 2027, or I'm sorry, years ending in 7 have a tendency to dip according to the decennial theory, which is exactly what starts to happen on this chart. So there's something strange going on there, and you can look historically at, like, compare this chart to what's actually happened, and it's pretty dang accurate as far as I can tell. So that's a fun one.
That's
What are your
this is
thoughts on that?
fascinating. Well, I was going to say, like, yeah, I mean, I think it's fascinating. Like I said, there's patterns. And I think what would be interesting to me would be to look at what governments do and like what the Fed has done. And since the Fed was started, and interest rates, and like, because we really should have freely floating interest rates. So the market should determine the interest rates, but they've set up a system with the World Bank and the Fed and all that. That's a whole nother topic, to where they control interest rates, which is just like it's just normalized for us now, but that's actually kind of a weird thing. Like that's not, and then they use it to control the market, and there's different things that they can do as well to control the market. But it'd be interesting to overlay some of this here, because like in 2008, they were lending out all these homes. They were giving subprime mortgages to, they should have been giving these mortgages to people that they knew, and then they would bundle them and sell them as a derivative. And so then you would have somebody would buy all these, but they don't know it's a junk stock or a junk bond, like a junk derivative or whatever you want to call it. And it exploded. It's why, because it was all worth nothing. None of these debts were going to be repaid. And so, but anyway, this says that's something that the regulators allowed, or that's what banks did and hit it. And I mean, it's disgusting. But anyway, at the top here, it says it says years in which panics have occurred and will occur again. And B says years of good times, high prices, and the time to sell stocks and sell stocks and values of all kinds. And C, it says years of hard times, low prices, and a good time to buy stocks and corner lots, etc. And so, anyway, it is fascinating to look at this and kind of see the ups and downs and what they have and how it coincides with what actually has happened.
Yeah, it's very cyclical too. Here, I want to answer this question real quick because I think it's an interesting thing to note. One of the problems, though, with that is if something bad happens, people find out so much quicker now and they react quicker. Well, yes, that's true, but it's kind of like I think of it this way. yes, people do find out quicker and they react quicker. But if you've noticed the extreme volatility in the market right now, not only do they react quicker, but so does the market. The market reacts quicker too. So it would be wise to expect a dip at some point here in the near future. But I think that the dip is going to hit hard and it's going to bounce just as hard as it hit. And that's just how the market is right now. You see it all the time. You'll see people reacting crazy to the market, and it takes a dive and everybody panics, and then it takes a deeper dive, and then people are short attention spans come into play. We forget all about it, and then the next day it's regulating and normalizing and back up again. So it's just as quick coming in as it is going out, I guess is what I'm saying. So that's the difference is it's responsive like that. So that's my thought on that.
And I think it's interesting too. It'd be neat to see, like, if you look at trade volume and who's actually panicking and who's actually doing this, because I think the vast majority, I don't know if it's like 70 or to 90%, that's quite a range, but is institutional investors with the actually share of daily trading volume versus retail investors like you and me, just kind of doing our thing around 20 or 25% more recently. But I don't actually know if those numbers are accurate. That was just a quick search that I did, but it's, it's it sounds right. I thought it would have been even higher for institutional investors, when you look at that sort of thing, even if you look at currency trading and that sort of stuff. But this is, so our big conclusion here is that, a correction probably is coming, whether it's going to be a big crash or not sure. But I think that some of those other crashes in the past were related to, people losing jobs and then panicking and selling what they had because they didn't know what was going to happen, and all this big panic that really didn't necessarily need to happen. And so, with how information travels today, it seems like, we're more well-informed, but at the same time, panic can also travel pretty quickly as well. But I think that people are rightfully suspicious now of information they're being given, and perhaps may vet things out a little more than previously. So, but any final thoughts before we wrap up here, Doug?
Well, I just want to let everybody know that I've been going deep down this rabbit hole this morning, especially with this Dicial Theory and all of that. And man, I found some crazy connections that we did not have time to cover this morning. So if you guys are interested in the next level down the rabbit hole, please let us know in the comments, because I'm thinking about putting together something for maybe next week. And this is it will tie in with we here at Filibusted are faith-based, but we don't necessarily always talk about those things on the channel, but they do come up from time to time, and there are some biblical implications, but I think that they're metaphorical. And one of those implications happens to be trending right now, which is the whole, like, it's the end of the world on September 23rd thing. Just for everybody's information, I do not think it's the end of the world on September 23rd. But I do think some important things are going to happen. And I think that it is all related. There's a big circle of things happening with all of this. And it's a really, really interesting rabbit hole. So if you guys want to know what I came up with and what I found and the connections that I was able to make, then please let us know in the comments. And that's my final thought.
Yes, please do. Well, thanks, Doug, for joining. And everybody, thank you for joining. Make sure you like and subscribe, and that helps us out as well. And share these videos with friends if something strikes you. If somebody comes to mind, please share it with them. And make sure you check out our members-only content. You can get that right here on YouTube, and you can also get it over on Locals when you can interact with us there as well. So thank you for joining us, and we will be back live on Monday, and look for some other episodes this weekend. Thank you so much, guys. God bless, and we'll have a great weekend.